There is now a 21% flat income tax rate for corporations, including professional corporations. There's increased expensing of capital items. Business interest deductions are now limited. And there is a new 20% QBID, which is a qualified business income deduction that must be considered. While after-tax book income will likely increase for many businesses due to the reduction in the corporate income tax rate, there are enough other changes in the tax law that it should not be assumed that this increase in after-tax income will fall directly to the bottom line as profit and therefore increase the value of the business. Business appraisers need to discuss in depth with management their other plans for their tax savings. The Tax Act provides for an increased amount of Section 179 expensing of up to $1 million of tangible personal property, while also increasing the definition, expanding the definition of what that tangible personal property is. Then there's a declining percentage schedule of immediate expensing of bonus depreciation that must be considered. It's going to be important for business appraisers to discuss these depreciation amounts and management's plans for capital expenditures when they're building their discounted cash flow models. It will be important for business appraisers to use longer-term discounted cash flow models if they're going to capture the sunset provisions of these bonus depreciation provisions of the Tax Act. These provisions sunset after 2026, so if a discounted cash flow model is not run out past this date, the effect may be to overvalue a company. The Tax Act limits the deductibility of business interest expense to 30% of adjusted taxable income. This provides another opportunity for business appraisers to discuss with company management what their plans are for their tax savings dollars. Will they pay down debt or will they do something else with the tax savings? It will be important for business appraisers to have in-depth discussions with company management regarding their plans for their enhanced cash flows due to their tax savings. For example, some companies may pay bonuses to employees or increase compensation. They may decide to pay dividends to shareholders. They should also think about, will their customers be looking for price decreases from them, or conversely, could they obtain price decreases from their suppliers? With regards to the market approach used in business valuation, EBITDA multiples may rise over time due to the enhanced cash flows companies are experiencing, which increases company value. So we'll have to watch in the future for valuation dates after 2018. If an appraiser uses comparable company transaction multiples that occurred prior to the enactment of the Tax Act, companies may be undervalued.